Most investors fail not because the market betrayed them, but because they couldn't master their own emotions long enough to let mathematics do its work. There's a truth about wealth that nobody wants to hear, a truth so simple that people spend their entire lives looking past it, searching for something more complicated, more exciting, more immediate. And that truth is this: building real wealth has almost nothing to do with intelligence, and almost everything to do with temperament. The ability to sit still while everyone around you is running in circles. The capacity to endure boredom while others chase excitement. The discipline to let time compound your decisions instead of constantly interrupting the process with new ones. That if you're committed to understanding how wealth actually builds, hit that subscribe button now. This channel exists to cut through the noise and deliver the rational thinking that creates lasting financial security. People think making the first million is hard, and they're absolutely right. But what they never understand until it's far too late is that the second million comes faster, much faster than the first. And it's not because you suddenly became smarter overnight, or because you discovered some secret investing strategy that nobody else knows about. It's because compounding finally starts doing the heavy lifting for you. The boulder you've been pushing uphill for years suddenly crests the ridge, and gravity flips. Now it's rolling on its own momentum, gathering speed, gathering mass, and you're just trying to keep up with something you set in motion years ago. Everyone worships the idea of getting rich quickly. Our culture celebrates the overnight success story, the brilliant trade, the perfect timing. But the truth about wealth is that it doesn't move in a straight line. It crawls for years, then walks, then suddenly sprints. Those first few years feel like pushing a boulder uphill with nothing but a spoon and your bare determination. Every inch forward hurts. Every small mistake feels potentially fatal. The progress is so slow it's almost invisible. Then one day, after you've almost given up hope that anything will ever change, gravity flips. The boulder starts rolling itself. The money you saved years ago is now generating returns that dwarf your current salary. Your investments are working harder than you ever could. Most people quit before they reach that inflection point. They think the game is fundamentally broken, that the system doesn't work, that compounding is just a myth told by people who got lucky. But the only thing broken is their patience. They can't endure the long, silent phase where nothing appears to be happening. When Charlie Munger made his first real money, he didn't rush out to buy a new house or upgrade his car or celebrate with expensive luxuries. He bought more assets. Then he waited. That's the part nobody likes to hear, the waiting part, because compounding looks desperately boring at first. A million becomes 1.05 million. Then 1.1. You look at those numbers and think, that's it. That's all I get for a year of waiting. But if you can just give it time, if you can resist the urge to interrupt it, the mathematics becomes absurd. In 10 years it doubles. In 20 years it quadruples. In 30 years the numbers stop making intuitive sense. And by that point, it's not you making the money anymore. Your money is making more money than you ever could through your labor. What's the biggest financial mistake you've learned from so far? Drop it in the comments below. Learning from each other's experiences is how we all get better at this. The first million is pure sweat and discipline. The second million is mathematics finally working in your favor. Charlie Munger watched bright young people earn fast money, only to burn it even faster. They chased shortcuts, always looking for the next quick win, never understanding that shortcuts are expensive in ways that don't show up immediately. They didn't understand the simple rule that once you hit escape velocity, once you build enough mass, wealth compounds without your permission. It happens whether you're watching it or not, whether you're thinking about it or not. But to reach that point, you must survive the grind. That slow, painful, invisible phase where nothing seems to happen, where your friends are spending freely and you're saving relentlessly, where everyone thinks you're being too cautious, too conservative, too boring. That's where character gets built. And that's precisely why most people fail. They fundamentally underestimate time. They overestimate luck. And they completely misunderstand exponential growth. The second million isn't twice as hard as the first. It's 10 times easier, because compounding isn't linear, it's exponential. It's like watching paint dry for years, and then suddenly realizing you've built a cathedral. The transformation happens slowly, then all at once. Here's what people consistently get wrong about compounding. They think it's an investing trick, some clever financial strategy that smart people use. It's not. Compounding is a behavioral advantage. It rewards consistency, not brilliance. Discipline beats IQ every single year. It's a quiet process with no fireworks, no applause, no dopamine hits to keep you engaged. And here's the thing about that, the world is absolutely full of people who cannot stand boredom. They'll trade a guaranteed fortune later for a small thrill today. They'll sell stocks that double every decade to chase cryptocurrencies that double every week. They can't help themselves. That impulse is human nature, and human nature is the enemy of compounding. When Warren Buffett and Charlie Munger started their investing journey, they weren't geniuses with secret knowledge. They were just stubborn enough to let time do its job. Everyone else was busy predicting recessions, timing markets, jumping in and out based on headlines. They were busy holding good businesses. They didn't need to be fast. They just needed to be right long enough for mathematics to take over. Because money, like gravity, starts working in your favor once enough mass builds up. Let's walk through the actual mathematics to make this concrete. Say you start with $1 million. At a 10% annual return, which is roughly what the stock market has historically delivered over long periods, that million doubles in a bit more than 7 years. At that point, you're making about $100,000 a year without lifting a finger, without going to an office, without answering to anyone. Your money is working while you sleep. In another 7 years, it doubles again to $4 million. Now it's generating $400,000 a year. Did you work 4 times harder? Did you get 4 times smarter? No. You just waited. You let time and mathematics do their work. But that's the part nobody wants to believe because it sounds too simple, too boring, too slow. Make sure you're subscribed because we're about to reach the core insight that changes everything about how you view wealth building. They want to hack the system. They want passive income without the years of active discipline that creates it. It doesn't work like that. Charlie Munger once said the big money is not in the buying and the selling, but in the waiting. People laugh at that insight until they realize how few investors actually wait. Most of them can't even hold a stock for 4 months, let alone 4 decades. They think patience is for monks, for people without ambition. They're completely wrong. Patience is for millionaires. Patience is for people who understand that the market loves to transfer money from the impatient to the patient, from those who can't sit still to those who can. The difference between 1 million and 2 million is not knowledge. It's temperament. It's the ability to sit tight when everyone else is running around trying to outsmart the market, trying to find the next big thing, trying to feel smart and active and engaged. The market doesn't care about your activity level. It cares about your results over time. And over time, doing nothing usually beats doing something. That's the real secret nobody talks about at cocktail parties or in financial media. You don't have to be faster than other investors. You don't have to be smarter or luckier. You just have to stay in the game long enough for time to start compounding in your favor. You have to survive your own emotions for long enough that mathematics can rescue you. The tragedy of investing is that most people never see the exponential phase. They change strategies right before the curve turns sharply upward. They switch funds because performance has been flat. They chase trends because standing still feels like losing. They complain that compounding is too slow, never recognizing that slow is smooth and smooth becomes fast. When people used to ask Charlie Munger how they could make their money double, he would tell them something that sounded almost insulting in its simplicity: sit still long enough. That's how the rich really get richer. Not through excitement and activity, but through endurance. Not by brilliance, but by boredom well tolerated. You cannot believe how quickly 1 million becomes 2 once you stop interrupting the process. Which of Munger's principles do you find hardest to practice in your own investing? Let's discuss this in the comments. Everyone says they believe in compounding until they actually have to sit through it. Then they get bored, or anxious, or worse, they get clever. Patience sounds noble in theory, something everyone agrees is valuable. But in practice, it feels like watching everyone else win while you stand still. And human beings are not built for that sensation. We evolved to react, to chase, to move. Our ancestors survived by taking action, not by sitting patiently. But investing punishes motion. Every unnecessary move costs you time, costs you taxes, costs you peace of mind. That's the paradox of wealth building. In most areas of life, doing more gets you more results. In investing, doing less gets you everything. When Charlie Munger was younger, he thought intelligence was the key to success in investing and in life. Later, after decades of observation, he realized that intelligence without patience is like an engine without fuel. It doesn't matter how powerful your car is if you can't keep it on the road long enough to reach your destination. The market tests your emotional endurance far more than it tests your IQ. You'll watch mediocre investors get lucky for a while. You'll see bubbles inflate and idiots get temporarily rich. You'll feel that itch to do something, to join the party, to not miss out. That's precisely when you lose, because compounding only works when you don't interrupt it. The urge to act, to tweak, to optimize, to trade is what ruins most portfolios. Charlie Munger said it plainly, the world is full of bright people who can't sit on their hands. They get intellectually restless, and the market feeds on their impatience like a predator feeds on weak prey. They chase new ideas like toddlers chasing shiny toys, and they end up broke both intellectually and financially. You have to make peace with inactivity. You have to learn to enjoy the boredom. You have to be okay with looking stupid for a while, with missing rallies, with letting others tell stories about their big wins while you have nothing exciting to report. That's desperately hard to do in a culture obsessed with speed and instant results. Everyone wants instant gratification, instant validation, instant transformation. Patience has become an antique virtue, something our grandparents valued, but that seems irrelevant in the modern world. But money doesn't care about your timeline or your culture's values. It compounds on its own schedule, not yours. Warren and Charlie used to joke that their favorite holding period was forever. They weren't kidding or exaggerating for effect. They genuinely understood that the real money is made in waiting, not predicting. They knew that most people underestimate how psychologically hard that waiting actually is. People imagine compounding as a peaceful ride uphill, a smooth journey that gets easier over time. It's not. It's a long, dull, often uncomfortable process that tests your self-control at every turn. You'll doubt yourself constantly. You'll question your strategy when it underperforms for years. You'll envy others who seem to be moving faster, making more exciting moves, generating better stories. And that's precisely when you're being tested most severely. Patience isn't passive. It's a skill, an active resistance against stupidity, against envy, against fear. When markets fall, patience feels like pain. When they rise, patience feels like missed opportunity. Either way, you'll feel wrong most of the time. That's why very few people become rich from compounding. They simply cannot handle the emotional silence of doing nothing while the world spins around them. But let me tell you something that took Charlie Munger decades to fully internalize. Doing nothing isn't the same as being idle. It's a deliberate decision, a conscious choice. It's saying, I've made my allocation, I've chosen my strategy, and now I'll let time do the work. When you invest in a good business, you've already done 99% of the job. The last 1% is just endurance, just not screwing it up. It's like planting a tree. You can't dig it up every week to check if the roots are growing. That's what most investors do. They uproot their own success by checking too often, by caring too much about short-term results, by needing to feel active and engaged. People talk endlessly about market timing, about getting in and out at the right moments. Charlie talked about time in the market. The former is guessing, gambling, hoping. The latter is compounding, growing, building. And over decades, that's the only difference that truly matters. Let's be brutally honest about the modern investor. They're addicted to action. They refresh their portfolio every morning like it's social media. They want dopamine hits, not dividends. They want excitement, not returns. But the market doesn't reward excitement. It rewards discipline. The best investors Charlie Munger knew over his long lifetime shared one trait: they were emotionally dull. They didn't react to headlines. They didn't panic over volatility. They didn't confuse noise with information. That emotional dullness is a superpower in investing. It lets you sit through the storms and collect the long-term reward. In 2008, when the entire world was panicking, when banks were failing and retirement accounts were collapsing, Warren Buffett and Charlie Munger weren't running around trying to time the bottom or protect every dollar. They were looking for good businesses that would survive the crisis. And they knew with certainty that time would heal the wounds. It always does, if you own productive assets and avoid stupidity. Compounding takes care of the rest. The irony is that most investors fail not because they don't understand the mathematics, but because they can't handle the waiting. They know what they should do. They just can't do it. So if you want your million to turn into two, if you want your small nest egg to become genuine wealth, don't try to outsmart the process. Just wait it out. Because patience is what turns knowledge into wealth. Without it, you're just another smart person with no money, another person who understood the theory but couldn't execute the practice. The truth is devastatingly simple. Most people never get rich because they never stay rich long enough for compounding to start working. They don't lose because they picked bad stocks or bad mutual funds. They lose because they picked bad habits. Let's start with the most common habit that destroys wealth: impatience. People want the rewards of compounding without the timeline. They want to double their money every year, not every decade. So they gamble. They call it investing, they use sophisticated language, they read financial websites, but it's just gambling with better lighting and fancier terminology. The first rule of compounding is survival. You can't compound dead money. And most investors kill their money through impatience and overconfidence. It's tragic to watch. They buy high when everyone's excited, sell low when everyone's panicking, repeat the cycle, and then blame the market. But the market didn't rob them. Their temperament did. Charlie Munger always said that to get what you want, you must deserve what you want. And patience is part of that deserving process. You have to earn the right to compound by surviving long enough. Now, the second reason people never reach the compounding phase: debt. Debt is the enemy of time. It reverses compounding. It compounds against you instead of for you. You think you're making 10% a year on your investments, but your credit cards are charging 20%. That's not investing. That's bailing water from a sinking boat with a teacup. Charlie watched brilliant people make fortunes in business and lose them just as fast because they couldn't resist leverage. They thought debt was a shortcut to wealth. It's not. It's an amplifier of both good decisions and bad ones. And since most people make more bad decisions than good ones, debt multiplies stupidity faster than compounding multiplies wealth. The third killer of wealth: envy. Envy ruins rationality faster than any other emotion. You see your neighbor making money on some ridiculous new fad, and you think, maybe I should get in on that. That single thought has destroyed more wealth than recessions ever could, because envy forces you out of your own circle of competence. It makes you abandon what you understand to chase what you don't. Compounding requires focus. Envy breaks focus. And once focus is gone, compounding stops working. The fourth mistake: overdiversification. Now, this insight will make the index fund crowd nervous, but let Charlie's wisdom speak. If you own 50 mediocre companies, you don't have diversification. You have confusion. It's far better to know a few things deeply than to know many things superficially. Berkshire Hathaway wasn't built by owning everything. It was built by owning a few great businesses for a very long time. Concentration is what lets compounding do its real work. Diversification only makes sense when you have no idea what you're doing. If that's your situation, fine, buy the index. But don't pretend it's brilliance. It's ignorance insurance. Hit that subscribe button if this rational approach to wealth resonates with you. We're building a community of patient, disciplined thinkers. The fifth and final mistake, interrupting compounding with lifestyle inflation. The moment people start earning more, they start spending more. New car, bigger house, fancier vacations. They destroy the base before it can grow. Charlie called that anti-compounding. They plant a tree and then cut it down every 5 years to make furniture. You can't build wealth if you keep resetting the clock. The first million isn't meant to be spent. It's meant to work. And if you let it work, it will work harder than you ever could. Charlie saw this cycle repeat over and over across decades. A young person saves diligently, invests wisely, finally reaches some success. Then they decide they've earned the right to spend, to enjoy, to reward themselves. And within a few years, they're back near zero. Why? Because compounding was just beginning when they turned it off. Money is like a snowball rolling down a hill. But you have to start early, roll it patiently, and never stop halfway down when the slope is about to get steep. Most people never make it to the steep part. They quit during the flat part when progress feels impossibly slow. They underestimate time. They overestimate their own cleverness. And they forget the single hardest truth in all of finance: wealth rewards endurance, not brilliance. Look at the history of great fortunes. They weren't made by people constantly jumping in and out of markets, constantly adjusting, constantly optimizing. They were made by people who bought good assets and sat through decades of boredom, panic, noise, and chaos. Every compounding curve looks flat at the start. That's when the world tests you most severely. You'll think nothing's happening. You'll feel like a fool for waiting while others are taking action. But that's the price of admission. And if you can just stay in the game long enough without losing money, without blowing up, without getting greedy, time will eventually take over and do the work for you. The formula is brutally simple: avoid debt, avoid envy, avoid stupidity, and let time handle the rest. The irony is that simplicity is what makes it so hard, because everyone wants to feel clever. And compounding doesn't reward cleverness. It rewards restraint. If you can master that, if you can learn to do nothing for long enough, you'll see the miracle that everyone else gave up on right before it would have appeared. Everyone wants to be a millionaire. Almost nobody wants to go through what it actually takes to become one. The first million is like lifting a boulder uphill with your bare hands. Every inch forward hurts. Every mistake feels potentially fatal. And the progress is so slow it's almost invisible. That's why most people quit halfway up the mountain. They think the climb is endless. They can't see the slope flattening just over the next ridge. But here's what Charlie Munger understood: that painful climb is not a bug in the system. It's the main feature. It's what filters out the tourists from the serious players. When Warren and Charlie say the first 100,000 is the hardest, they're not being metaphorical. They mean it literally. Because during that stage, compounding hasn't woken up yet. You're relying entirely on your own savings, your own discipline, your own restraint. There's no momentum helping you. It's all muscle, all willpower. That's when you discover who you really are. Are you the type who can live below your means for a decade? Can you say no when everyone around you is saying yes? Can you endure years of being underestimated, of looking foolish, of missing the parties? If the answer is yes, congratulations. You're statistically rare, because most people won't even survive the boredom, let alone the discipline. The first million isn't really about money. It's about behavior. It's the training ground where you build the habits that will protect every dollar that comes after. It's not glamorous. It's not exciting. It's slow, repetitive, and brutally humbling. You'll question why you're doing it. You'll watch your friends spend freely while you save relentlessly. They'll mock you for driving an old car, for skipping luxuries, for living smaller than you could afford to. But here's the punchline that makes it all worthwhile: by the time they're drowning in lifestyle debt and financial stress, you'll be compounding. And compounding doesn't care about mockery or social pressure. It just keeps growing quietly, relentlessly, inevitably. When Charlie Munger was young, he learned a principle that shaped his entire life: the pain of discipline is always less than the pain of regret. That's what the first million teaches you. It's not about clever investments or exotic strategies. It's about habits. Boring, consistent, stubborn habits. Save more than you spend. Avoid stupid risks. Stay out of debt. Own good assets, then wait. That's the entire secret, written nowhere because it's too simple, ignored by everyone because it's too boring. The tragedy is that people think they're too smart for that simplicity. They want sophistication. They want techniques that sound impressive at dinner parties. They want to feel like they're doing something special. But making the first million isn't special. It's mechanical. It's persistence multiplied by time. If you earn a decent living and save diligently for 10 or 15 years, you can get there. It's not easy, but it's not impossible either. What makes it hard isn't the mathematics. It's the emotion. People sabotage themselves with impatience. They chase shortcuts because the long road feels too long. They can't sit still, and the market punishes that restlessness. Every time you reach for fast results, you trade your compounding future for temporary excitement. Charlie met countless people who made $500,000, even $750,000, then lost it chasing the next big thing. They never realized. They were just inches away from escape velocity, the point where their money would start working harder than they ever could. But they never let compounding take over. They reset the game instead. And that's the real heartbreak of investing. Most people fail right before they would have won. So yes, the first million is hard. But it's supposed to be. That struggle is what forges the patience, humility, and endurance that will keep you rich later. Think of it as your tuition fee for financial freedom. You pay in discipline and years and self-denial. But once you graduate from that phase, the rest becomes easier, because after that first million, something almost magical happens. The machine starts running itself. The same habits that once felt like punishment now feel like power. You stop chasing money, and money starts chasing you. Most people never make it to that stage because they think they're losing time. But what they're really losing is faith in time itself. You can't rush compounding. You can only respect it. And once you do, once you truly internalize that lesson, the rewards stop being linear. They start being exponential. 1 million becomes 2. 2 becomes 4. 4 becomes 8. That's when people start calling you lucky. But luck had nothing to do with it. It was just the mathematics of patience finally becoming visible. So if you're stuck in that first million grind right now, if it feels impossibly slow and frustratingly hard, remember this: the struggle isn't a sign you're doing it wrong. It's proof you're on the only path that actually works. The ones looking for shortcuts are just wandering in circles, destined to start over repeatedly. Keep walking your boring, disciplined path, because once you hit the summit, gravity does the rest. Compounding doesn't reward enthusiasm or excitement. It rewards endurance, pure and simple. And the moment it finally starts working, it feels like magic, except it isn't magic at all. It's arithmetic disguised as a miracle. You spend years feeling like nothing is happening, like you're wasting your time. Then suddenly everything happens at once. That's how wealth sneaks up on you, slowly, then all at once. People think there's some secret turning point, some switch that flips when you hit $1 million. But what really changes is leverage. Time starts doing the heavy lifting instead of you. When you're broke, time works against you. Bills pile up. Debt compounds negatively. Every mistake costs you years of progress. But when you have capital, real patient compounding capital, time becomes your employee. And unlike human employees, it doesn't call in sick, doesn't ask for raises, and never stops working. Every dollar you own is a tiny worker. You send it out to earn more dollars. Then you reinvest those earnings, and soon you have an army. That's compounding in its essence, an army of silent workers building your freedom while you sleep. The key word there is freedom. Because the end goal of compounding isn't more money for its own sake. It's control over your time, your choices, your emotions. When people used to ask Charlie what wealth buys, he would tell them something profound: the ability to stop playing stupid games. Most of the misery in life comes from financial pressure, from doing things you don't like with people you don't respect, for money you don't actually need. Compounding frees you from that treadmill. But you don't get that freedom by chasing returns. You get it by obeying discipline long enough for compounding to reward you. It's the most boring path and the only one that works reliably. Tell me in the comments, what principle from this lesson will you apply starting today? Let's hold each other accountable. Here's the insight most investors never grasp: wealth compounds fastest when you stop touching it. Every trade, every tweak, every attempt to improve performance is usually just self-sabotage with fancy mathematics. In the long run, inactivity beats brilliance. It's the same principle in life. You don't become wise by jumping from one philosophy to another every month. You pick a few sound principles and you let them compound over decades. Over time, they turn into judgment. Judgment turns into reputation. Reputation turns into opportunity. That's the compounding effect of character. Money is just one visible form of it. Once you've saved your first million, you'll notice something strange and wonderful. Your money begins to grow faster than you can save. Your returns start dwarfing your paycheck. It's an odd sensation the first time you realize your portfolio is earning more than your labor. That's when compounding becomes freedom. You stop worrying about every small expense. You stop chasing short-term wins. You stop caring what the market does this week, because you've built something that moves on its own momentum now. It's like discovering you own a goose that lays golden eggs. You don't have to squeeze it, shout at it, or make it run faster. You just feed it and let it live. Yet most people, foolish as ever, can't resist killing the goose. They dip into their investments for non-essential purchases. They chase something more exciting. They interrupt the process right when it starts accelerating. And then they genuinely wonder why compounding never works for them. Here's the truth that Charlie Munger lived by: compounding rewards the boring. It favors those who can leave their money alone long enough for nature to take its course. That's why he and Warren said for decades that their favorite holding period is forever. Not because they're sentimental, but because they're coldly rational. The longer you hold a great asset, the more invisible work it does for you. And it doesn't just grow wealth. It compounds peace of mind. Once you understand this at a deep level, your entire mindset changes. You stop looking for the next big thing. You start looking for durability, for businesses that will survive, for strategies that won't crumble under stress. That's real wealth, peace through patience. But here's what surprises most people when they finally reach this phase. When compounding finally clicks, it doesn't feel like greed. It feels like calm. You no longer need to prove anything to anyone. You don't need to rush. You don't need to gamble. The machine is already running. That's the phase where wealth becomes effortless, where the second million arrives faster than you ever imagined possible. But it's not luck. It's the delayed reward of 10,000 small, boring, correct decisions. It's the product of not being stupid for a very long time, and that's what most people underestimate: how powerful not being stupid can be when you multiply it by decades. They think you need genius-level intelligence. You don't. You just need endurance. Charlie saw plenty of geniuses go broke over his lifetime. But he never saw a truly patient person fail at compounding. So yes, it feels like magic when it starts working. But it's really just mathematics powered by discipline and time. And if you respect those two forces long enough, they'll do something no job ever can. They'll set you free. If compounding is the eighth wonder of the world, then human stupidity is the ninth wonder. And it's far more common. Compounding builds quietly over decades. Stupidity destroys wealth instantly. You can spend 30 years carefully stacking bricks, and one dumb decision blows the whole structure down. That's the ratio you're working with: slow gain, fast ruin. Charlie said for years that Berkshire's success wasn't because they were smarter than everyone else. It's because they tried harder not to be stupid. That's a massive difference that most people miss. Most people want brilliance. They want to outthink, outguess, outtrade everyone else. They can't stand the idea of being ordinary but consistently right. They'd rather be flashy and wrong because at least that makes for good stories. The market loves people like that. It eats them alive, because compounding hates drama. Every act of stupidity, every panic selling, overtrading, excessive leverage, every bout of envy, it all interrupts compounding. And once you interrupt it enough times, it's gone forever. Let's start with the most popular flavor of stupidity: greed disguised as ambition. Greed convinces you that just a little more will finally make you happy. It tells you that a 10% return is boring, that 20% is mediocre, and that 50% is possible if you're smart enough. That's how intelligent people end up broke. They don't lose to bad mathematics. They lose to bad psychology. When Charlie and Warren talk about avoiding stupid mistakes, they're not just talking about bad investments. They're talking about bad impulses. The impulse to do something because everyone else is doing it. The impulse to buy because the price has been going up. The impulse to double down because you can't possibly be wrong twice. That's not intelligence. It's self-destruction with a spreadsheet. Charlie watched this movie play out for 80 years, and the ending never changes. A new generation shows up convinced they're smarter than the last. They invent new toys and new products, but it's the same disease: overconfidence. And the cure has always been the same: humility. But humility isn't fashionable or exciting, so people keep paying expensive tuition to the market, decade after decade after decade. Here's a rule that should be taught in every school: if you can't tolerate being bored, you're not fit to be an investor. Because boredom is the camouflage of compounding. It looks dull on the outside, but it's quietly working miracles in the background. And people who can't stand that stillness will always interrupt it. That's why most fortunes die in the second or third generation. The builders were patient. The heirs get clever. They think compounding will forgive stupidity. It won't. The market doesn't care about your intentions or your intelligence. It punishes impulsiveness and rewards endurance. Always has, always will. And stupidity doesn't just come as greed. It also comes disguised as fear. Fear makes people sell great assets at terrible prices. Fear turns temporary volatility into permanent loss. Fear makes you confuse price with value. And once you let fear drive your decisions, compounding stops cold. Fear and greed are just two sides of the same foolish coin. They both make you abandon rationality. And underneath both emotions is ego, the biggest enemy of all. Ego tells you that you can predict the future. That you'll get out before the crash. That you'll buy back in when it's cheaper. Good luck with that. Charlie never met anyone who could do it consistently. The ones who try spend their lives playing financial hopscotch, missing the real wealth that comes from just sitting still. At Berkshire, they avoided stupidity by embracing what Charlie called intelligent laziness. They preferred sitting on their hands to swinging wildly at every pitch. They bought good businesses, let them compound, and resisted the urge to look clever. Because cleverness is what kills most investors. They want to be right every week instead of rich every decade. Charlie and Warren were content to look stupid in the short term if it made them rich in the long term. That's a trade most people won't take because their ego won't let them. Now you might ask, why are people so drawn to stupidity if it's so costly? The answer is simple: it feels good. Stupidity gives you excitement. It gives you stories to tell at parties. Compounding gives you silence and spreadsheets. But here's the thing: wealth is built in silence. Ruin is broadcast loudly. If you want to see human stupidity in real time, turn on financial television. It's an entire industry built on the fear that you might miss something. They'll make you believe that constant action is necessary because their profits depend on your movement. But your wealth depends on your stillness. So don't play their game. Don't try to be the smartest person in the room. Just aim to be the least foolish. That's what Charlie did. That's what Warren did. And it worked out fine, because compounding is fragile in one specific way. It can survive market volatility. It can survive recessions and bear markets. But it cannot survive stupidity. So your real job as an investor isn't to find the next big thing. It's to avoid doing the next dumb thing. If you do that long enough, the mathematics takes care of everything else. Time is the most loyal partner you'll ever have in wealth building. It never cheats, never panics, never gets emotional. It just keeps showing up, one day after another, ready to multiply whatever you give it. The problem is most people never form a real partnership with time. They treat it like an enemy. They rush it, fight it, waste it. And then one day they realize that compounding doesn't work for the impatient, and by then it's usually too late to recover the years they lost. Compounding is fundamentally a deal you make with time. You give it discipline, and it gives you wealth. You give it consistency, and it gives you freedom. You give it decades of your life, and it gives you peace in return. But you can't negotiate with time. You can't hurry it along. You can't trick it with clever shortcuts. You can only cooperate with it and trust the process. That's what people fundamentally don't understand. They look at Warren Buffett and Charlie Munger and think they made their fortunes by finding magic stocks or having inside information. No. They just let time do its work longer than most people can emotionally stand. The mathematics isn't complicated at all. 10% a year doesn't sound impressive when you first hear it. But over 40 years, that's 45 times your original money. It's not exciting in year 5 or year 10. But by year 40, it's absolutely absurd. The trouble is, most investors never live long enough in one strategy to see it actually work. They keep changing lanes, looking for faster traffic, hoping the next approach will be the one that finally delivers quick results. But wealth only builds when you stay on the road, when you pick a lane and stay in it through the boring stretches. Time doesn't reward movement or activity. It rewards endurance, pure and simple. And endurance is a mental game more than anything else. You'll need the discipline to stay calm when everyone around you is panicking. You'll need the humility to look stupid or old-fashioned for years while others chase the latest trends. You'll need the confidence to trust basic arithmetic more than your own emotions or the emotions of the crowd. Most people can't do that. They want certainty, not patience. They want excitement, not endurance. They want to feel smart right now, not rich later. That's why the market remains, decade after decade, a machine that transfers wealth from the active to the patient, from those who can't sit still to those who can. When Charlie Munger was a young man, he didn't have much money, but he had something far more valuable, time. And that's a greater asset than cash if you know how to use it properly. A 20-year-old with patience and discipline is wealthier in potential than a 50-year-old genius who can't sit still, because genius without time is just noise and activity. But time combined with discipline is destiny. People consistently underestimate what can happen in 30 years of simple, correct behavior. They overestimate what they can accomplish in 3 years, and that's why they burn out. They sprint in what should be a marathon, and then they wonder why they never finish the race. Time doesn't care about your intensity or how hard you're working in any given moment. It only cares about your consistency over years and decades. And if you understand that deeply, you'll stop searching for shortcuts. You'll stop comparing your timeline to someone else's highlight reel on social media. You'll realize that your wealth is growing in silence while others are chasing headlines and attention. At Berkshire Hathaway, they've had bad years, even terrible ones. But over the span of decades, those bad years don't matter at all, because time smooths out volatility and compounds the underlying fundamentals. That's the part nobody wants to hear because it's not exciting. You can be wrong in the short term and still end up right in the long term if you just give time enough time to work. Every mistake shrinks with patience. Every good decision magnifies with patience. As Charlie loved to say, the market is a voting machine in the short run and a weighing machine in the long run. And the scale only tips in favor of those who outlast everyone else. Time doesn't just grow your money. It grows your wisdom if you're paying attention. If you live through enough market cycles, you start noticing patterns. You realize that human nature doesn't fundamentally change. Only the costumes and the language change. The same mistakes repeat every decade with new packaging, new bubbles, same emotions driving them. The people who survive and thrive are the ones who remember those patterns. That's the real beauty of time in investing and in life. It exposes the fads and rewards the fundamentals. Every get-rich-quick scheme looks brilliant until you extend the timeline far enough. Every boring, sensible plan looks boring until you extend the timeline far enough. Time is the great equalizer. It makes fools look foolish and the disciplined look brilliant. But you only get that payoff if you stay in the game long enough to see it. Charlie used to tell young people all the time, start early. You don't need brilliance when you're young. You need runway. You need decades ahead of you. Because every year you delay starting, the slope gets steeper. You'll have to save more, risk more, hope more, all because you didn't let time do its simple, predictable job when you had the most of it available. The best thing you can do for your financial future is not to chase higher returns or find the perfect investment. It's to give compounding as much time as possible to work its magic. There's no substitute for time. You can't outsmart the clock, but you can befriend it. And once you do, once you make peace with decades instead of demanding results in months, life gets dramatically simpler. You stop needing miracles. You start trusting basic mathematics. So if you want to make real money, don't look for secrets or insider tips. Look for time. And when you find it, when you're young enough to have decades ahead, don't waste it. Don't interrupt it. Don't trade it for short-term excitement. Because time, unlike opportunity, never knocks twice. Once those years are gone, they're gone forever, and no amount of brilliance can buy them back. Compounding money is relatively easy once you understand the principles. Compounding character, though, that's the genuinely hard part. And without character, your wealth won't last anyway. You can't separate the two, because money left in the hands of someone without character simply amplifies their foolishness. Compounding doesn't make you smarter or wiser or better. It just makes your consequences bigger, whatever they may be. If you're disciplined, time will multiply your fortune. If you're reckless, time will multiply your mistakes. The mathematics doesn't care which side of that equation you're on. That's why Charlie always emphasized that wealth is not built by intelligence alone, but by temperament. It's not about how smart you are. It's about how well you behave when life gets rough, when markets crash, when everyone around you is panicking or celebrating irrationally. The compounding process demands emotional stability. And emotional stability comes directly from character, self-control, humility, patience, honesty. Without those traits firmly in place, you'll interrupt your own progress 100 times before you ever see real results. Let's start with humility. It's the foundation of successful compounding because humility allows you to admit you don't know everything. And that admission is what keeps you from constantly touching and adjusting what's already working. The world is absolutely full of brilliant investors who eventually blow up because they can't stop proving how smart they are. They turn a simple process into a performance, into theater. But compounding isn't impressed by theatrics or clever moves. It's impressed by consistency, by boring repetition of sound principles. Then there's integrity. If you lie to others, you'll eventually lie to yourself. And self-deception is absolutely fatal to building wealth. A person who lies about reality will misprice risk every time. They'll overestimate their own ability and underestimate their own stupidity. That's a guaranteed recipe for financial disaster. You cannot build lasting compounding wealth on a crooked foundation. It might rise fast initially, but it collapses even faster. Look around at history. Every major financial scandal started with someone thinking the rules didn't apply to them. They confused intelligence with invincibility. Time punished them all eventually. Next comes discipline, the boring, repetitive kind. The kind that tells you no, you don't need that new car. No, you don't need to make a trade today. No, you don't need to prove anything to anyone. Discipline is the muscle that holds compounding together when greed and fear start pulling at it from different directions. It's the ability to stay steady when your emotions are screaming at you to do something, anything, to feel in control. And then there's gratitude. People overlook it completely, but it's a quiet force of stability in wealth building. A grateful person doesn't take reckless risks. They don't gamble what they already have for what they don't truly need. Ungrateful people blow up their wealth because enough never feels like enough to them. They move the goalpost every single time they score. And that constant, restless chase kills compounding dead. Wealth doesn't stick to restless, dissatisfied minds. It sticks to calm, grateful ones. Character is what allows you to stay calm when things go wrong and stay humble when things go right. Without it, you'll sabotage yourself at both extremes. The truth that most people miss is that getting rich and staying rich require almost opposite skills. Getting rich requires focus and sometimes aggression. Staying rich requires restraint and humility. Most people master the first skill and completely fail at the second. That's why fortunes vanish as quickly as they appear, leaving nothing but stories behind. You can see this principle in markets, but you can also see it throughout life. Good relationships compound over time if you're consistent. Reputation compounds if you're patient and fair. Wisdom compounds. Health compounds. But only if you behave with the same principles that make money compound: avoid stupidity, delay gratification, stay rational when others lose their minds. That's the hidden connection between wealth and character that nobody talks about. They grow from the exact same soil, which is long-term thinking. You can't fake that. You can't rent integrity or lease discipline. You either have them built into your character, or you learn them through painful experience. Charlie lived long enough to see both sides clearly. He saw people with average intelligence become genuinely rich simply because they stayed consistent for 40 years. And he saw certified geniuses go completely broke because they couldn't stay humble for 4 minutes. Character is what keeps you from touching the compounding machine unnecessarily. And touching it repeatedly, interrupting it constantly, is what ruins everyone else. That's why Charlie said over and over throughout his life, success isn't about being brilliant. It's about not being stupid and staying that way long enough for time to reward you. Compounding is ruthless in one specific way. It never forgives arrogance. It rewards those who respect its simple rules and destroys those who think they can outsmart basic mathematics. So if you want lasting wealth, build character first. Build the habits of patience, discipline, humility, and rationality. Because when compounding finally meets character, when those two forces combine, something truly remarkable happens. You not only get rich, you stay rich. And more importantly, you stay sane. And sanity, my friends, is the ultimate form of wealth. You can have all the money in the world, but if you're anxious, paranoid, and miserable, you haven't won anything at all. Most people fundamentally can't stand boredom. That's the real reason they'll never be rich. They confuse activity with progress, noise with achievement, motion with results. But real compounding happens in complete silence. And silence feels unbearable to the restless mind. If you can't stand watching paint dry, you're simply not cut out for serious investing. Because compounding looks exactly like that for years and years. Nothing seems to move. Nothing seems to happen. And then suddenly, everything moves at once. That's the paradox that trips everyone up. The people who can sit through years of apparent nothingness are the ones who wake up one day and discover their money has doubled or tripled. The market doesn't reward excitement or activity. It rewards patience so boring that most investors can't emotionally survive. At Berkshire, Charlie and Warren made billions not by being clever, but by being patient in a world that can't sit still. They would rather hold one truly great company for 50 years than 50 mediocre ones for 1 year each. And every decade that passes, that decision looks smarter and smarter. The truth is stark, boredom is not a weakness. It's a signal. It tells you you're finally doing something right. It means you've stopped chasing shiny objects and reached the phase where compounding takes over. The first million was earned by grinding, saving, and resisting constant temptation. The second million is earned by doing almost nothing except not screwing it up, not interrupting the process, but doing nothing is the hardest thing in the world for most people. They can't help but poke at their portfolios, fiddle with their allocations, chase new trends they read about. They can't sit still, and that restlessness is precisely why they lose. The financial industry thrives on your boredom. They know the exact moment you feel restless, you'll trade, click, subscribe, and pay fees. And every unnecessary move you make feeds their pockets, not yours. You can't win their game. You win by refusing to play it at all. Make sure you're subscribed to this channel, because understanding these principles is just the beginning. Applying them consistently is what separates those who build real wealth from those who just talk about it. When someone used to ask Charlie what they should do when the market gets volatile, his answer was almost insulting in its simplicity: nothing. Absolutely nothing. And they would look at him like he'd lost his mind. But here's the mathematics they never learned: doing nothing during volatility protects the compounding process. Doing something, making moves, almost always interrupts it. Think about it this way. Every trade you make is a tax on your future wealth. It might not show up on your statement today, but it steals from the future curve of compounding. If you can resist that urge, if you can tolerate the stillness and the boredom, you'll outlive most investors financially. Boredom is your moat. It keeps you separated from the crowd, and the crowd always loses eventually. When everyone's chasing action and excitement, boredom becomes a form of courage. It takes genuine guts to sit quietly while everyone else is shouting about crisis or opportunity. It takes wisdom to say, I don't need to do anything today. That's the paradox of the second million. You earn it not by doing more, but by doing less. The hard part is purely mental. You'll feel guilty for not being productive. You'll think you should be optimizing, trading, adjusting something. You'll think inaction means laziness or ignorance. But in investing, inaction is often brilliance wearing a disguise. People dramatically underestimate the power of not interrupting a good thing. They want to participate in every trend, every wave, every story. But the wealthiest people Charlie knew were the ones who said no 99 times out of 100. You have to learn to find beauty in boredom, to see it as a feature rather than a bug. Because that's where compounding hides its real magic. When you stop tinkering with your portfolio, it stops leaking value. When you stop checking prices every hour, your anxiety stops compounding alongside your money. And when your anxiety stops compounding, your money finally can compound freely. Boredom builds the second million. Not brilliance, not excitement, not innovation. Just steady, dull, disciplined waiting. You don't need to predict anything. You don't need to outsmart anyone. You just need to stay put while everyone else self-destructs through activity. It's not glamorous, but neither is real wealth once you understand it. Wealth is calm. It's quiet. It's patient capital paired with a patient mind. When you master boredom, you master compounding. Because boredom means you've stopped chasing and started building. And if you can endure that silence long enough, something extraordinary happens. The money begins to snowball faster than you ever imagined possible. You realize the second million came easier than the first, not because you changed strategies, but because you stopped changing strategies. That's the moment most people never reach, when doing nothing finally pays more than doing everything. So the next time you feel bored with your investments, don't see it as a problem that needs solving. See it as proof that you're on the right track. Because in the long game of wealth, boredom is not your enemy. It's your shield, your advantage, your secret weapon. And it's the one superpower no speculator will ever have. Most people spend their entire lives chasing wealth, running after it like it's always just out of reach. The few who truly get rich understand something fundamentally different. You don't chase wealth. You cooperate with time and let wealth find you. Time is the most powerful force in all of finance. But it's also the most underappreciated, the most ignored. It's invisible. It doesn't brag or show off. It just keeps working quietly, steadily, while everyone else burns themselves out trying to get there faster. Let me tell you something blunt, something Charlie Munger believed to his core. If you need excitement to stay invested, you're going to lose money. If you need constant validation, you're going to lose patience. And if you lose patience, you lose compounding. End of story. The goal is not to outsmart the market or outguess other investors. It's to outlast your own emotions, your own worst impulses. Charlie saw fortunes built on the most dull, repetitive routines imaginable. Save, invest, wait, repeat. Save, invest, wait, repeat. And he saw fortunes destroyed by brilliance that couldn't sit still for more than a few months. It's never the mathematics that ruins people. It's the ego, the restlessness, the inability to let a simple process work without interference. Compounding works the same way throughout life, not just in investing. The older Charlie got, the more he realized that wisdom compounds, relationships compound, peace of mind compounds. But only if you protect them from chaos and constant disruption. You can't compound your mind if you're constantly distracted by every new thing. You can't compound your reputation if you cut corners or act without integrity. And you can't compound your inner peace if you let envy and comparison dictate your choices. Wealth without peace is just another form of poverty, just misery with a bigger bank account. And the road to peace is paved with patience, with accepting that good things take time. Let's make it simple as it can possibly be. Getting rich is a game of arithmetic, of basic mathematics. Staying rich is a game of temperament, of controlling your emotions. Living well is a game of character, of who you are when nobody's watching. If you master all three of those elements, time becomes your partner instead of your predator. When you start genuinely cooperating with time, everything slows down in the best possible way. You stop caring about the daily scoreboard. You stop obsessing over short-term performance. You realize that the right question isn't, how can I get rich quickly? The right question is, how can I stay sane and rational while getting rich slowly? Because sanity is dramatically underrated in this world. Everyone wants more money, more status, more of everything. Very few people want a calm life built on sound judgment and steady growth. But that calm life, that's the real jackpot. Charlie and Warren built Berkshire Hathaway on this exact philosophy. Buy good businesses. Let time work. Avoid stupidity. Repeat. There's no magic formula, no secret sauce. Just patience, discipline, and the humility to not screw it up. And it worked spectacularly because it always works. The mathematics of compounding never fails. Only people fail by interrupting it. Here's what most people don't realize until it's too late. If you respect time, it multiplies your wealth exponentially. If you fight time, if you rush and force things, it multiplies your mistakes exponentially. Every day you spend rushing is a tax on your future. Every day you stay patient is a dividend you can't see yet but will collect later. The problem is we live in an age that glorifies speed above almost everything else. Fast money, fast fame, fast results, fast everything. But what's fast rarely lasts, and what lasts rarely needs to be fast. That's why Charlie always said, take a simple idea and take it seriously for decades. Compounding is that idea. Simple, boring, brutally effective over time. You don't need a new strategy every year. You need endurance. You don't need better opportunities. You need better habits. You don't need to chase brilliance. You need to avoid stupidity consistently. That's all there is. That's all there ever was. If you follow those principles long enough, if you can stay rational and patient for decades, your wealth will grow beyond your imagination. And your life will get quieter, calmer, more serene. When people eventually ask how you did it, you can tell them the simple truth: I just stopped doing dumb things, and I gave time a real chance to do its job. That's the great irony of compounding. The richest results come from the simplest behavior, from boring consistency. The world won't understand it because they don't have the patience to see it through. But you will, because you stayed. You endured. You let time make you rich without losing your sanity or your soul in the process. That's the real endgame here. Not just wealth, but wisdom. Not just growth, but genuine peace. If you can have both of those things, if you can build wealth while maintaining your character and your calm, you've won the only game worth playing. So the next time you feel that urge to act, to do something, to make a move, remember this: money compounds, wisdom compounds, and stupidity compounds too. Choose very carefully which one you feed with your time and attention. Because time, your quiet and ruthless partner, will multiply whatever you give it. Choose patience. Choose discipline. Choose the long view. That's how you win.